welcome everyone. This is becoming a regular thing. I do enjoy doing these tax updates. This is kind of the main topic that I live year in and year out. So it, uh, it's something that I find enjoyable. The As Dawn mentioned, we're going to be recording this program today, and I know that probably most people are going to watch the recording. But if questions arise during the program, throw something out there in the Q&A. I'll try to keep an eye on that and try to address those as we go along. And Don might cut in if there's something that's kind of cutting edge that we really need to clarify as we move along. Again, Don said, I'm Rob Holcomb. I'm with the University of Minnesota Extension. I'm coming to you today from my office in Marshall, Minnesota, in the southwestern corner of the state, and it's kind of wet and rainy here today. So the fall is definitely in the air, and and as we move on with the program here, this is a slide that I use all the time. This is kind of our general disclaimer here. So, folks, I always encourage folks, whether it's a tax issue, whether it's a legal issue, be a good consumer of professional services. Oftentimes, uh, I, I, I really, really feel that producers that try to do their own tax return really do themselves a disservice. Yeah, they might be saving themselves the fee of paying the tax professional for doing the return, but did they get to take advantage of all the things that they would have been able to take advantage of had they gone to a credentialed tax professional? The same thing holds true with the legal side as well. There's typically a clear delineation between accountant stuff and lawyer stuff. I just encourage everyone, be a good consumer of professional services. Today's program, I'm largely drawing from three different sources. The Land Grant University Tax Education Foundation, or the acronym that stands for, is LAGUDF. That's the nonprofit organization that I work with. They produce all the textbooks that we use for our income tax courses, and in fact, I've got ag schools going on the next 2 days, and next week our 2 day short course starts as well. Some of the information is coming directly from the IRS website, and IRS does have a well-populated web page. It is reputable information. And the third area where we're pulling stuff from is ruraltax.org. Now, ruraltax.org is a group made up of a group of extension educators from across the country. We all serve on the National Extension Income Tax Education Committee, and we collectively will write fact sheets and help self-help materials. There's some tools on that website. Everything on that website is free. All right, so I'd encourage you, check that website out. There's a lot of good material on that website. Timing wise, today I'll probably present for, I'm guessing, just a little over an hour, and then we'll allow time. We'll allow plenty of time for questions. Because I know that those are, it's easy to come up with questions on the tax side of things. So, as far as the agenda goes today, all right, I want to spend a little bit of time talking about the components of HR 1. Now, HR 1, also known as the One Big Beautiful Bill Act, that was that big tax legislation uh, reform bill that was signed into law on July 4th this last summer. Uh, it's a huge piece of legislation. I just want to look at some of the components that are going to be more likely than not to affect producers. In fact, this morning I was helping to put together for our 2-day courses. We have approximately a 2-hour presentation just looking at the tax reform bill, and I was helping put together the presentation for that, and it's massive. Yeah, it's massive. We're not going to get into the details on that. We're just going to talk about some kind of high level things. Uh, I also want to talk a little bit about record systems and how that integrates with your tax return Schedule F. Also, weave in a little bit of discussion on 4797. That we're going to spend a lot of time on that, but I think in order to understand and be able to put together a really good set of books, you need to understand where the end product is going, and that's why we're going to be talking about that. And then the third prong of what we're going to talk about here today is we want to review some of our tax planning strategies, particularly year end. Now, my assumption is most everybody listening to this is probably a calendar year filer, so your year ends December 31st of this year, and any tax planning that needs to be done needs to be completed before the business end of business on New Year's Eve. So that's more or less what direction we're going to be going with this. Now, the address a couple things on the One Big Beautiful Bill Act, also known as HR1. I'll probably refer to that as the OBA uh, legislation. So HR1, it's a massive piece of legislation. All right, it's got 12.9 trillion in tax provisions. So it really uh, it really was not a small piece of legislation. The negative part about it is that over the next 10 years, the Congressional Budget Office is estimating it's going to add to the deficit about 3.4 trillion more dollars to the national debt, which that I won't editorialize on that, but that's just what CBO is projecting. Now, largely what HR1 did is go back to 2017. We had the passage of the Tax Cuts and Jobs Act. All right, we're several years down the road from that, but that was in 2017 one of the first major pieces of legislation that had happened in over 30 years. So the 2017 legislation, that was a big deal. But the reason for HR1 was that when they passed the 2017 legislation, Congress decided to pass that through the reconciliation process, meaning that they didn't have to have 60 votes in the Senate. And when they do that, according to correct congressional rules, it puts a timeline. There's a deadline on how long that type of legislation can last. All right. And it was a lot of the provisions of that tax legislation from 2017 was going to expire at the end of 2020, or excuse me, at the beginning of 2026. So that was why for the push, because there was a lot of stuff, tax rates, all the stuff, a lot, major pieces of the 2017 legislation was going to expire once we got into 2026. So tax rates were going back up. Essentially the tax rules were going back to what we had in 2017, adjusted for inflation. So that was why there was this big push to get this done. Why Congress ran that through in July. So just a couple things that we want to talk about here. And I don't have a terrible amount of slides on this, but some of the provisions that were made permanent out of this new legislation. All right, you may or may not have heard. There's an estate and gift tax exemption that we use when we're doing estate planning. All right. Now, the uh, what HR1 did is it set that amount permanently at 15 million and it's indexed for inflation. So the amount of federal exemption on estate tax is huge. All right, it's a large number. It's indexed for inflation, and it was made permanent with that regard. Now, the other piece that happened is there's a type of accelerated depreciation that we can do. It's called bonus. And bonus over the last few years has been, it was set originally by Tax Cuts and Jobs Act at 100%, but it's been phasing down, and that was part of the legislative process. It was written in the Tax Cuts and Jobs Act that bonus was going to phase down over the several years. That HR1 put back to 100% also made that permanent. All right. Now, and we'll get more into depreciation a little bit later. It also bumped up the amount that we can use for Section 179. Now, Section 179 is also another form of accelerated depreciation. We might use 179 to do a fast write-off on a piece of machinery that we bought. Uh, we can do the same thing essentially with bonus. There's some subtle differences between the two, but largely, those two provisions, bonus and 179, are both set in place in order to do a fast write-off of items that we would normally have to depreciate. So other permanent provisions, QBI. You probably heard of qualified business income. This is a 20% deduction that came into play back in the Tax Cuts and Jobs Act back in 2017. This also is a provision that was made permanent. Now, what QBI is you on an income tax return, you're looking at the total business income, trade or business income, and we can take a 20% deduction from that. And that's what QBI is. Now, there's limitations. If we get a real high income individual, there's phase outs where if income gets too high, we're limited on the amount of QBI that we can take on a particular return. There's also other permanent provision is ag loan interest exclusion. This is primarily for lenders. All right, but the idea is that the idea of this legislation was to try and lower borrowing costs for farmers. So there's the banks are getting a break on interest that they collect from farm loans. Other things that we want to touch on now, in addition to the tax provisions, there were also some farm bill provisions that were put in there. Now, we still don't have a new farm bill. Technically, the farm bill is expired. We're operating under an extension of the old farm bill, but this was stuff that was added into HR1. Main thing is if somebody is doing production of covered crops, such as where I'm at. I mean, I'm pretty much in the middle of corn and soybean country, where I'm sitting right now. So the PLC and the which is price loss coverage and ag risk coverage, the PLC and the ARC. Now, the old farm bill established reference prices. Now, those reference prices have been increased. All right, we're seeing an increase in those statutory reference prices. Also, we have changes in the guaranteed amount for those farm programs. So we've seen some enhancements in farm program payments. Plus, producers can now elect to they can reallocate their base acres, and producers it's always advantageous if you got covered crops and you have an opportunity to update your base acres. Never avoid the opportunity to do that. I mean, that is something that you always want to do. All right, the commodity payment limits. The legislation also upped, prior to The HR1, our payment limits were limited to 125,000 per farm or per individual. That's been bumped to 150. Also, on the crop insurance side of things, the government paid premium subsidies did increase for crop insurance. The uh, the other things, moving on to some other things now. These are some things may not necessarily affect farmers, but I wanted to talk about them a little bit. There is a temporary deduction for seniors. All right, and this is part of HR1, but this is only in effect for tax years 25 through 28. All right, but what it is, it's for people that are 65 years of age or older. If now I won't turn 65 until next year, but next year I'll be eligible for this. So next year I'm going to be able to take an extra $6,000 deduction on my tax return just by virtue of the fact that I'll be 65. All right, so a 65-year-old gets an additional deduction on their tax return. All right. And it is for married filing joint returns. There are some thresholds to phase that out. And that's also on the bullet or on the third bullet there. You do have to have a social security number in order to take advantage of this. So those are kind of that the high level things that HR1 did. Now, one final note on the on HR1, rural on the ruraltax.org website. All right, if you go to that home page, and I think Don either emailed or is going to email out the a PDF of my presentation. You scan that QR code or you just go to ruraltax.org, that'll take you to that web page. On that on that landing page, there's a section for the new legislation, and there is a free summary that was written back in uh, back in August by committee members. I think Adam Katrovich from Clemson was, I think, the main author on that. But it's if you're looking for an extensive write up on all the changes there, that would be my go-to place to go get that summary. It's free. All you got to do is just you can download that thing as a PDF. So next thing, let's kind of talk a little bit about records and the components of records and see what we can do with this. Now, uh, folks, I started out as a high school ag teacher longer ago than what I probably want to admit, but I taught high school ag for 6 years before I started doing the tax and analysis work and I've been at that for, I guess this will be 35 years now. So I'm not going to say that I've seen a lot. I've seen everything, but I've seen a lot anyway. But the discussion on records has always intrigued me because some producers really recognize that, this is something I could do that's going to help improve the profitability of my operation. It's going to help me improve my efficiencies. It's going to help me make better decisions. But it's something that it does require some self-discipline in order to get it done. All right. Uh, and I think once people realize the value of it, it becomes a higher priority. All right. Now, I will be the first one to admit farmers inherently want to be outside farming. The last thing that they want to be doing is sitting at a desk, rat-tat-tatting on a computer or entering stuff into a manual record book, which not many people nowadays are going to do, but they'd rather be outside farming. All right, we need to understand that this is one of those activities that's going to help you make more money in your operation, right? It will. So, you know, why do we keep business records? Well, of course, to monitor the progress of the business. We have a saying. When I first came to the university, I was a fieldman for one of our farm management associations, and when I was with the association, we had a saying: If it isn't written down, it doesn't exist. And that is as true today as what it was 20 years ago. All right. We can use records to determine profitability, analyze the business. It's the only way that we know whether the farm is making money or not. Preparing financial statements, which is becoming more and more of a critical thing. I mean, if you're going into the banker acquiring financing, you do need to have, it's a requirement, and it isn't the bankers being a bad guy. That's just a requirement that they have to have those statements on file. Track receipts and expenses. Ultimately prepare that tax return. All right, because that tax return, we need to have a good set of books to back up those numbers that we put on there. Which I could probably combine the last two bullets. I mean, the records support that tax return. Now, Schedule F, what where I'm going somewhere with this, trust me. Now, as far as the Schedule F is the form that we file with the tax return to report farm income and expense. All right, plain, pure, and simple. Now, why do we want to file those things now? I know with native producers, we've had a lot of there's been a lot of misinformation and the like about that. But if you haven't filed tax returns in the past, I encourage you to do so, because that Schedule F, if you've got that return filed, that oftentimes is that critical thing that you have to have in order to be eligible for FSA programs, which might be, some type of government program or a government loan program. So, the filing of a Schedule F and a tax return is really, really critical on that. Plus, filing that tax return oftentimes is going to make you available for other things. I mean, even with all the tax reform that we've seen over the last 6 months, the earned income credit is still out there. I mean, and for somebody that happens to have a low income below that threshold, filing a tax return could end up getting you, it could pay some dividends, because you might end up qualifying for credits that you otherwise wouldn't be able to get. Now, as far as the profitability goes, the Schedule F by itself is a poor thing to look at by itself to determine the farm profitability. The reason for that is that we end up, usually for tax planning purposes, we mess around with a lot of things. We might prepay some expenses for next year in order to minimize the income in the current year. That skews that profitability portion of that as well. Plus, it's not uncommon for producers, if they have a tax liability out there, they might buy a new piece of machinery and write it all off with either Section 179 or bonus. And if they do that, well, that also skews that profitability. So what we do with looking at profitability is we start with Schedule F, but then what we do is we do beginning and ending adjustments based on the balance sheet. All right. What we start with, what we end with, are there changes between the ending and beginning balance sheet? And then we adjust the Schedule F accordingly. All right. So that's commonly what we refer to as an accrual adjusted net farm income. Now, as far as records go, folks, uh, most folks are going to be doing something with computer software. A very common program. I know a lot of folks that will buy. There's a product put out by Intuit. It's called Quicken. It's been around. Quicken's been around for oh shoot, over 30 years. I think I bought my first copy of that like about 1991 or something like that. So it's been around for a very, very long time. But it's relatively inexpensive, as long as the chart of accounts is set up properly. It works slick. It does a nice job of reporting income and expense. Now, if you're wanting to graduate to more of a farm specific program, shoot me an email sometime. I'll give you my email here at the end of the program. But shoot me an email and I can send you some links. There's a program out of Iowa that I personally use, and I recommend to all of our association members. It's called PC Mars. It's a PCMARS. Uh, it it's going to run you about $70 a year for the base program, but the thing that's beautiful about it is it's got a numbers column, it's got a weight column. You can track your livestock sales, you can track your bushels, you can track your quantities, and it's really something that's built for the farm. All right, and it's been around for a long, long time, and it's a good program, and it's a lot cheaper than QuickBooks. I mean, some folks are using QuickBooks, and unless you're getting into heavy payroll or anything like that, I don't think QuickBooks is probably a good bang for your buck. It's very, very expensive for just using it for a basic farm program. So the other option, folks, is just to get a manual record book. I mean, the FSA offices still give away hand kept record books. I have some that I can, there's one I can get a hold of from one of my professional organizations that essentially is a copycat off the old farm credit record book that I remember from the late 70s when I was in high school. So, those are still around for those that want to do that. As far as the records program, record systems go, uh, your record system should include a separate section for farm income, separate section for farm expense. All these are separate sections. You want your capital assets and purchased and sold, want them in a separate area. All right. You want those in a separate area. I like to balance all my money coming in and out, so I'm going to keep track of my loans too. All right. And I also encourage folks to keep track of that personal family living, because if you don't write it down, it doesn't exist. All right. Now, let's kind of look at the components of a Schedule F. Now, this is actually this was a Schedule F that I used for a lender program last January, but there's the numbers on here really aren't important. But what you're going to notice here is every one of these lines on Schedule F, and we're not gonna detail all of these, but we've got livestock sales up here at the top, and grain sales. We've got co-op distributions. We've got crop insurance, custom hire, other income. This is where all the income gets reported. And in your record system, you need to make sure that you can differentiate the stuff on the income side. So if you have, you know, raised calves that were sold, you need to code those as such. That's going to be an item that's going to end up on line two. Is where that's going to happen. And if you're selling grain, or if you're selling, if you've got, for instance, if you were doing it like a farmer's market type of situation, that's also going to be sale items on line number two. All right. So your records need to kind of emulate what's going on with this. Now, on the bottom part of the Schedule F, all right, again, these are all the different kinds of expenses that we can have. So on the expense side of things, we've got car and truck expense, chemicals, conservation expenses. If you had custom hire, I'm not going to read through all of these, but all of these different types of expenses, we need to be able to pigeonhole these into your records program. All right. So if we're buying, if you're buying, feed, say you go to town and you're buying creep feed for your calves. All right. Well, that's going to end up getting coded as feed, and ultimately that number is going to end up showing up on line 16 under feed, just for instance. All right. If you go to town and you buy some baling twine, or just general supplies, that's going to get reported on line 28. Right. So that's predominantly why I like to look at the Schedule F, because if you understand how stuff gets divided up on the Schedule F and you do the same thing with your records, oh, your tax professional is going to be so happy with you. Now, let's touch on one other thing here briefly that we need to look at here a little bit, and that's Form 4797. All right. Now, 4797 is a form that we use for sales of business property. One of the most common mistakes that I see native producers make is, folks, once you put animals into the breeding herd, and that means, if you're holding calves, if you're holding heifer calves back, and you're trying to breed them to keep, if you're planning on keeping them and you're going to try to breed them, at that point in time, they became breeding stock. All right. Breeding stock gets sold on 4797 and not Schedule F. All right. That right there is 90% of what I want to talk about on this slide. All right. The reason why we want to sell that stuff on 4797 is because breeding stock, once we attempt to breed an animal, that animal becomes breeding stock. If we end up culling that animal, we sell them as breeding stock. If we report something on schedule on 4797, we don't pay self-employment tax on it. If we put it on Schedule F, we do. All right. So first of all, breeding stock sales don't get reported on Schedule F. All right. You actually are paying a lot more tax than what you need to if you're reporting it that way. All right. So that's the key point that I want to hit here. This is more information than what you probably need, but the different parts of 4797. Main thing is when I mentioned earlier that we needed to have a portion of the records that were for capital assets bought and sold. That's where that breeding stock gets put. All right, you put that in a separate spot from where the Schedule F stuff is, so that way your accountant at tax time can pluck that out and get that reported in the proper place. Okay, let's talk a little bit about tax management and planning. All right, I dive into our second topic, and yeah, that I took a little longer than what I planned on that, but I think that was important to talk about that. All right, this is my perennial chart that I use when I talk about tax rates and everything. I'm going to get my laser pointer going here. So what this is this chart represents federal income tax rates for 2025, and it's based on married filing joint status. If we were to do single or head of household, I mean, this chart would look similar. It's just the dollar amounts would be different. Now, what this chart makes up, this chart, if you have a state income tax in your respective state, this is not accounted for on this chart. But uh, income tax rate wise, there's a little bit of a 10% bracket, there's a 12% bracket, and then we get to a 22% bracket, and then we jump to a 25% or 25% bracket out here. And so what, the blue line is the tax rates for respective amount of money. All right. The orange dotted line is the self-employment tax, which is 15.3%, and it runs out to the maximum that maximum number. There's a maximum amount, there's a Social Security maximum out there, and it's 176,000 something for 2025. At that point in time, the you know there's two components to self-employment tax. There's the old age survivor disability insurance, which is the 12.9 or 12 point, it's 12%, and then there's a 2.9% Medicare portion that goes into infinity. All right, there's no cutoff on that. So that's why we have this 2.9% continuing out over here. The green line just is adding everything up. All right. So tax planning wise, if somebody walks in the door the 1st of November and they present their records to me, and we look at it, I'm projecting out where they're probably going to end up at the end of the year. If they're up here in the middle of the big green hump, oftentimes what I'm going to recommend for them to do is to either prepay expenses or do something to get that income from here down to here. All right, because getting rid of this really expensive money that's up here in this really high bracket, you're going to get a big bang for your buck for money that you spend to go from here to here. All right, and we got an example that we'll look at here a little bit later. All right, now, agriculture right now in certain areas is kind of going through the ringer a little bit. Especially the area that I'm in right now. We're pretty much really heavy corn, soybeans in the area where I'm at, and prices are really bad. I mean, they've been bad for going on 3 years. Now, if we have low income and we want to bump the income up, all right, what we can do is we can accelerate sales, we can postpone expenses. Don't use fast write-off if we buy a piece of machinery. We also can amortize our fertilizer. We could spread our fertilizer cost over several years if we wanted to. Plus, if we have a big repair bill, we could capitalize it. In other words, we could depreciate it over a period of years rather than taking it all as one expense in that given year. All right. So our tax planning strategies, what we look at is the things we're going to look at here real briefly is, we're going to look at prepaying expenses, income averaging, deferring income, taking accelerated depreciation, or maybe doing some crop insurance deferral. So let's take this a thing at a time. Now, prepaying expenses is something that we are able to do without too much worry. Well, without any worry at all, as long as we're doing it right. The general rule for doing prepaid expenses is you need to look at this 12-month rule. All right, you're okay as long as the benefit of the expense doesn't extend beyond 12 months after the benefit begins or the end of the following tax year. So if I'm buying fertilizer for the coming crop year, it's going to get used the next year. That's perfectly okay to prepay that. All right. A good example of this is if I were paying for say I had a 1 year insurance premium that I'm paying in November, right? That's okay because it it doesn't give me more than 12 months of benefit and it ends before the end of the following year. All right. You can't prepay interest though. All right. You can't prepay interest. So you can only deduct interest that I paid that it was actually accrued. Now, on prepaids, this is probably the most important slide of anything I'm going to show you on the prepaids. It's got to be a payment, not a deposit. All right. If I get client coming in and they show me their paperwork and it shows on the co-op statement that this was money paid on account or money held on account. No, you need to have something saying I bought this. I bought this for this amount of money, and that's what we have to have. Valid business purpose. Well, that's easy. We're fixing price and also assuring ourselves of supply, and we just can't materially distort income. And once you start prepaying, you're typically going to keep on doing it. So that's the piece on prepaying. Income averaging. This is something that everybody with farm income can do. All right. Now, the whole idea of income averaging is there's a form that we do. Sorry, the form we file this on is called Schedule J. Now, it only works for farm income. Income averaging does not affect self-employment tax or taxable income. All it's doing is it's blending the rates. That is all it's doing. So when we're looking at income averaging, all right, now here's a good example of where income averaging would do us some good. Uh, this solid line here is that theoretical top of the 12% bracket over the last over the period of time from 22 through 25. All right. So everything down here below the line is going to be 12%. Everything above the line here is going to be a 22% bracket. All right, much higher rate. Now, let's say, for instance, that we had a producer that had income below the line, below the line, below the line, and all of a sudden in 25 they've got, they have a lot of income in 2025. What income averaging is going to allow us to do is we could take an equal amount of money and put it back into these prior years, and we can fill up these empty, unused 12% brackets. Now, the the requirement is we have to put, if we've got 30,000 we were putting back into the prior 3 years, it'd be 10,000, 10,000, 10,000. We put 10,000 here, 10,000 here, 10,000 here. We cannot change that. It has to be equal going back for each of the prior 3 years. Uh, but what that does is that allows us to get some 12% treatment on money that otherwise would have been taxed to 22. All right, so very powerful tool. Uh, talk to your tax professional about this. It requires filing of one form. You don't have to amend returns. You just have one form to fill out, and that's it. I mean, it's relatively easy. So let's talk a little bit about deferring crop and livestock sales. Now, this is a hot topic. If you've got enough income in the current year and you want to defer those sales into the following year, you want to avoid the constructive receipt rules, because constructive receipt rules say, well, if I could have got it, I have to count it as income. All right. So the thing, I'm going to use a Minnesota example here for you, but say if I'm a farmer and I'm taking a truck of corn to the ethanol plant. Well, we run it over to the ethanol plant, run it across the scale, and then I walk in they got the check cut by the time I get into the office, and what I tell the operator, I tell the manager, hey, I want you to hold on to that check till after the first of the year. All right, that doesn't work, folks. I mean, they cut the check, the money was available to me, I had constructive receipt. All right, so at that point in time, we've got to take that income. All right, now the way to get around that is you do a deferred payment contract. All right. Now, if I was same scenario, I'm taking a load of corn over to the ethanol plant over at ADM. All right. Everything is the same except before I run the truck across the scale, I walk into the office and I say, all right, I'm going to want to defer this sale until 2026. Right. And we go ahead and we do the paperwork and have that in place so that they're not cutting a check, then I don't have constructive receipt and I'm able to uh, get rid of that. I'm able to move that money so it's not going to be taxable until next year. Now, the downside of that is when you do those deferred payment contracts, you are an unsecured creditor, meaning that if the buyer has financial problems before the 1st of January, you're not very high on the list to get paid out of the bankruptcy court. All right, so that is the risk. So you don't want to do that unless the buyer, is in pretty good financial shape. All right, weather-related sales of livestock. There's actually two different things that we're going to look at here, and on that, the first one is the breeding stock provisions. The breeding stock provisions. Now, here's what would happen if you had a situation where you were under extreme drought, all right, and you didn't have enough hay, you didn't have enough feed, you ended up having to sell some of your breeding livestock, or you sold part of your breeding herd off because you didn't have enough feed due to weather related conditions. All right, under those circumstances, with breeding livestock, what we can do is we can defer that sale into we can defer that into a forthcoming year. The bottom line is when we do the breeding stock, what we do is we sell it. It's a deferred sale. We have to buy it back within a 2-year period of time. All right. So we need to buy that back inside of 2 years. We don't have to recognize the gain from the original sale. All right. Now that works for breeding livestock. Now for all of the lives, this works for all livestock. If you normally would have sold the livestock in question in the following year, but you ended up selling it early due to weather-related circumstances, we can do that deferral into next year automatically. Now this provision does require you to be in a federally declared disaster area, or you have to be in an adjacent county to a county that was declared a federal disaster area. So on the all livestock side, we have to have a federal disaster declaration in order for this to work. On the breeding livestock, previous slide, if we're doing breeding livestock, we can defer that without a without a disaster declaration. And in essence, we're not really deferring it. What we're doing is we're just postponing the gain, but we have to ultimately end up buying those animals. We have to replace those animals within a 2-year period of time. All right. Next thing that we've got here is depreciating assets. Let's talk a little bit about what do we have to depreciate. Now, first thing that we worry about with depreciating assets is when did we place it into service. Now, placing it into service means when did we get delivery of this and it was ready for use in its intended purpose. All right. Case in point, it's not uncommon for farmers to buy machinery at the end of the year because they're looking for a tax write-off. All right. Now, harvest may be done and a farmer may buy a combine. They may take delivery on the combine. It's sitting on the home place. If we had something to combine in late December, which is highly unlikely, it's considered placed in service. If we needed to use it, we could. All right. So that's more or less what placed in service is. What doesn't work, folks, I've seen people that what they did is they bought a machine shed and the semi shows up with all the pieces and parts and beams and all the stuff and it got unloaded in the barnyard, but it wasn't assembled. All right. That is not placed in service. All right. Yeah, they paid the bill, but it wasn't placed in service, so there'll be no depreciation on that in that current year. Now, uh, recovery period. All right, this is important because when we're looking at farm equipment, all right, this goes back to changes that were made by Tax Cuts and Jobs Act back in 2017. New equipment is 5-year property. Used equipment is 7-year property. And see, grain bins and fences are still 7-year property, and that's going to catch kind of the majority of the things. The If you build a building, a general farm building is going to be 20-year property. Single purpose ag structures are considered 10. Now, single purpose ag structures are typically going to be a livestock confinement building or a greenhouse. And when I say greenhouse, it needs to be the greenhouse with irrigation set up inside and also some type of climate control system. All right, just a plain old high tunnel is not going to be single purpose. That's going to end up being a 20-year property. All right. So we touched on 179 and bonus a little bit ago. The HR1 significantly increased the deduction for 2025. I mean, the maximum deduction is $2.5 million with a purchase limit of 4 million. And what that purchase limit means is if the farmer goes over the 4 million on the purchase limit, then it's a dollar for dollar reduction of what they're eligible to take for 179. All right. Now, this chart comes right out of publication 225. All right, the Farmer's Tax Guide. This is a chart that's in the depreciation chapter in Pub 225, and it lists your various types of assets that you might purchase that are subject to depreciation. The column that you need to pay attention to, folks, is the GDS, the General Depreciation System column. All right, this is going to be the one that most folks are going to use most of the time. And the 179, it's telling you yes or no whether those assets are going to qualify for 179. Depreciation, bonus depreciation, or also called additional first year, this was made permanent by HR 1. Talked about that just a little bit earlier. And now that only is going to work for property acquired after January 19th of this year. So as long as you purchase something after January 19th, it's going to be eligible for bonus as long as you're in that 3 to 20 year property category. And refer back. There's a reason why I put this slide here. Look at everything here in the GDS. All right, for bonus. All right, it literally everything listed on this sheet is going to qualify for bonus. All right. The only thing that's not going to qualify for 179 is going to be the farm buildings because it's 20-year property. All right. Everything else is going to qualify for uh, bonus in that regard. So bonus is another way that we can take fast write-off. And one thing to note also is that with regards to bonus and 179, we do have related party rules. If you buy something from a lineal descendant, you can't take 179 or bonus on it. All right, that's a critical thing that we watch. Okay, crop insurance. In case you got crop insurance payments this year, uh, if you're cash basis filer and you normally would have sold that crop that you got the payment for in the following year, you may be able to defer that into the following year under Code Section 451. Now, the okay, first of all, the when you defer crop insurance, we've had several different types of insurance plans that have come on the market in the last couple decades. One of the newer ones is it's called revenue assurance. It's essentially it integrates crop insurance with revenue protection. And if you have one of those policies, the only part of that that's eligible for deferral is the portion that's due to damage resulting from destruction or damage. I said that poorly. The only part that's eligible for deferral is the portion of that payment due to damage and destruction. All right. Revenue part we can't defer. All right. And crop insurance companies are pretty good at getting that split out for us. So when are we eligible for that deferral? We got to be cash basis, and under normal circumstances, we'd have to report that sale in the following year. Now, here's the rubber hits the road piece of this thing. We've got a revenue ruling out here, plus a Nelson versus Commissioner court case that we pretty much are obligated to adhere to. In order to defer crop insurance, we need to look at all crops. All right. Now, I know we got folks from all over the country on the call or on the recording, but where I'm sitting in Southwest Minnesota, predominantly most of the people that I'm going to be working with are growing corn and soybeans. All right, so if I've got somebody in the office here that's looking at deferring crop insurance, we need to look at, all right, first of all, soybeans. Are they normally selling over half the soybean crop the following year? If that's yes, we're good. Okay, ask the same thing of the corn. Are they normally selling over half of the corn crop the next year? If yes, if it's yes to both of them, then we're good to go. All right. If we're selling something right 100% out of the field, it poisons the well. We can't do any of it. All right. It's an all or none. It's an all or none type of thing. I don't agree with the interpretation, but what I think doesn't really matter in this regard. This is what's getting enforced. So shoot me an email if you got follow-up questions on that. So let's move on to our tax planning component. Now we've already looked at this chart once and kind of explained that these are the different brackets and those tax rates. This is assuming that everybody is all using all farm income subject to self-employment tax. Here is the top of the tool. Excuse me. This is the landing page for ruraltax.org. All right, this is not live. I did a screenshot of it, but a couple things worth noting on here, and this was as of a couple days ago. Uh, if you go to rural tax to the landing page here, please note here this top item here. It's one big beautiful bill implements significant tax package. That's an update on HR1. There's a second bullet here reviewing ag provisions of HR1 and tax update affecting farms and ranches. So any one of these three documents, I'd encourage you, if you're wanting to dig more deeper into the new tax legislation, that's that's where to go. I mean, those are free. All you have to do is go to that website. Again, it's ruraltax.org, and you can go there. The other thing worth noting on this is there is a current uh, farm income tax estimator tool that you can access. It's actually a downloadable Excel file that you can download. But this also on the landing page, that's this button down here at the bottom. That's all located on the landing page on ruraltax.org. All right, every single bit of it. So and time providing time allowing, I may pop that up and just kind of show that to everybody how that's going to work. Okay, so let's trot through the rest of this, and then I might pull up that tool here when we get to, well, I will. Shouldn't say might. Here's the 2025 tax brackets and tax rates. This is for our our different filing statuses. That's for single, married filing, joint, head of household. Those are the breaks for the different tax rates. That's just kind of FYI information. But what I did is I did go through using that tax estimator tool. I did go through there and did some calculations on this. Now, let's say, for instance, we have a farm, and I've got a lot of income on this thing by design. I'll show you some other scenarios of this as well. But what we have is, we had a projected Schedule F of $200,000. Assumption is no other income on this thing. So by the time you get done taking the standard deduction and all the deductions, the QBI and everything, we ended up with taxable income of 123,923. All right. If I did the calculation here, federal income tax was going to be just a little over 17,000. The self-employment tax was over 27,000. Total tax bill 44,000. Now remember, that's on $200,000 worth of income. All right. Now, where we end up with here is what I suggested on this is that we were going to prepay, working with this individual, we're going to prepay $20,000 worth of crop inputs, and we're going to take another $16,000 worth of 179. We're going to take some fast write-off on some equipment that we bought. All right. But the bottom line is we're adding $36,000 worth of expense. All right, which reduces the Schedule F to 164,000. And here's the numbers that we come up with. Taxable income is 96.7. Federal tax is 11,131. Self-employment tax is still 23,000. Total bill is 34,303, but we're in the 12% bracket. All right. So let's back up here a minute. We were going from 123 296. So folks, what we have here is, before we did anything to that, this producer was about right here on the income chart. All right, right in the middle of the big green hump where we're paying darn near 40% between between income tax rates and self-employment tax. And if you had a state income tax, that would be on top of this too. But what we did is we went from here by doing the prepayment. I got them down to here. All right. So I tend to pay a lot more attention to the bracket that people are in rather than just looking at the total dollar amount. All right, so somebody that was going from here to here is getting a lot of benefit from that money that they spent to go from here to here. All right. Now, let's summarize this a little bit. So what I did in this example is we essentially spent an additional $36,000 in prepayment and accelerated depreciation. We cut the tax bill by just about 10 grand. All right. So for every dollar that we spent, we're saving darn near 20 cents, 28 cents on the dollar. So so that's getting us a really valuable tax savings by going from that high bracket to the low bracket. Now, the thing that keeps us from saving that 40 cents on the dollar, like what the graph looks like, is that QBI deduction does skew that a little bit. So that ends up being that ends up being uh, it ends up being an elusive figure on that because the qualified business income deduction is happening in the background and we don't see it happening. So as income goes down, so does the QBI deduction. So that makes this chart not look as beneficial as what it is, but it actually is extremely beneficial. So so again, the chart that's here. Let's look here one moment. Um, in fact, one because I'm going to let this go away again. Here's my acknowledgments, questions, folks. I promised you. Here is my contact information, and I'll pull that back up again. I see a question here. Question is, what's the most valuable tax deductions for farmers and ranchers? I think the thing to concentrate on to the individual that asked that is we you need to make sure that you're spending money on something that is a farm related expense. I've sat there before and I've sat through presentations where folks weren't real clear. They were just walking into the room and they just told everybody just spend money. Uh, it needs to be for the farm business. All right, you don't put siding on the house or a roof on the house or those personal expenses. That's not going to do you any good on the farm side. I mean, it needs to be if you got a livestock operation, you need to look at uh, probably what's going to do you most good. I mean, maybe buying feed or buying hay or possibly putting up a building if you need that. So just I don't think there's anything that's a magic bullet type of expense, but you just need to make sure that it's something it's an expense for the farm. I've seen way too many people that went and spent personal stuff and they didn't get any good out of that. Other question that we've got here is, can you deduct conservation expense? Absolutely. On the conservation expense, it does need to be an expense that's approved the by USDA. Now, the only thing on conservation expenses is you are limited to deducting 25% of your gross farm revenue. All right. The so you got a 25% limitation on that. If you do something really big and it exceeds that 25% figure, you get a carryover. But you can only take that 25% deduction in that current year that you did that expenditure. But absolutely that does qualify. How are repairs versus improvements treated? The uh, we're getting into several years ago, IRS came out with some tangible property regulations, and the on the tangible property regulations, if you're replacing something that is a maintenance type of thing, you're able to deduct that. And for instance, if you're replacing belts and hoses and a piece of equipment, and it's part of the regular maintenance, there's no problem taking that deduction. In the case of improvements to a building, there is a complicated formula you need to probably talk to your accountant about, because that improvement is going to be a function whether you can take a deduction on that as a repair. It's a function of whatever the basis is in that building, and it's completely based on individual circumstances there. But that's a conversation that you probably want to have with your tax professional before you pull the trigger on doing some of those. That's an excellent question, but it does get kind of complicated on that. So, oh boy, responsibilities of an ag employer. Well, let's see. That's another hour-long workshop. Don, note this. I mean, I've got material on this. If we want to do this workshop sometime, maybe at the front end of the year, I'm game to do that. As an agricultural employer, and I'm assuming that you're hiring employees, giving them a W-2. The first thing is uh, whether we're in Indian country or not, you do need to do an I-9. I-9 is that immigration form. I know people grit their teeth and say, "Really?" I'm going, "Yeah, you need to do it." All employees need to have an I-9 done. I think everybody needs to do a W-4. And again, this is like another hour-long workshop. I-9 W-4s for everyone. Uh, when you have employees, you're going to have to, there's a component where you're going to have to do payroll. You need to decide whether you're going to withhold half the FICA and Medicare from the paychecks, and then pay that in at least quarterly. Or some folks opt to just pay both halves of the Social Security, and if they do that, then you got to gross up the check. And again, that's kind of a complicated topic to try and do in about 2 or 3 minutes. But main things are uh, I-9s, W-4s. Make sure you have a conversation with the accountant about how to get the payroll done correctly, and that's probably a good start on that. But and if you got more questions on that, I'd say shoot me an email, and I can probably follow up with you on that. Um, had my contact information up here a little bit. I do want to. Okay, I'm going to. Okay, hold on. I'm not dumping you now, but what I want to do is I want to show you folks this this worksheet that that I had. Okay, Don, can you help me out? Is that spreadsheet coming through okay?
Yep, looks good.
Okay, I'm gonna blow this thing up. Oop. Okay, we'll try that. Uh, Now I know this thing is probably looks like a complicated mess on here, folks, but this is something. As I said, this is something that the National Income Tax Extension Committee put out last, just well, it was just posted not too long ago. But what this has got all the tax rates in here, and if you're familiar with spreadsheets at all, I can click on these things. For instance, if I want to be a single individual, I can change that to single, or if I want to leave this thing as a married filing joint, I can do that. But what you can do is well, that example that I had in the PowerPoint a little bit ago, this is where I calculated the numbers. I had $200,000 of income. All right, now if I want to just change this, let's say for instance, okay, let's change things up a little bit. Let's say for instance that we got, current producers got, let's say 35,000 of income, and I'm going to blank out I'm going to blank those out. All right. So if we got a producer that has $35,000 worth of farm income, okay, what kind of a tax bill are we looking at? Well, we're looking at about a $5,000 tax bill. All right, is what we're going to have. Now, the part of this that makes things interesting is if we have 35,000 of if we got 35,000 of income, let's say I want to do 10,000 of prepayment on this. All right, and I drop this as 10,000, and I come down here to the bottom. I got to put the 35 in here. Okay, so we're going to duplicate this. So this column two is my option. See, what I did is I duplicated this, but I added 10,000 of additional expense, and by doing that, I'm going to save myself $1,500. All right, so that's where this chart works, and I know I'm doing a miserable job of explaining the spreadsheet, but if you go to the ruraltax.org site where you download this file, there's a video showing how to work the file. All right. So this is a tool that you're able to utilize, and I'd encourage you to do so. All right. Let's go back to my go back to my contact information here. Okay. So with that, flip back to my contact information. Don, did we have any other questions in the chat or anything that we needed to look at?
Nope, you got them all. But if
Okay.
anybody has any last minute questions, you're welcome to put them in the chat. Looks like we have about 15 minutes left, everybody, and I do see some people must have been off their lunch break and had to get back to their responsibilities. But I'll go ahead and do some closeout things. But Rob, is there any last
Just
things you
just
want to
want
add?
to just want to thank everybody for first of all, thank you for asking me to do this, and pleasure as always. And if anybody, I've got my contact up here. The folks, the one thing I will say is that if you are going to reach out to me this time of the year, I'm doing a lot of schools. Email is probably a better way to reach me this time of the year than the phone will ring on my desk, but if I'm gone, we're going to be playing phone tag. So, email might be the best way to get a hold of me.
Thanks, Rob. You have some thank yous in the chat as well.
I see
Um,
that. Thank you very much, folks.
Yeah. Thank you, Rob. We always appreciate you presenting to our audience. I know a lot of folks will be watching this on our YouTube channel and on our website. I just have a couple last things to name on our end here at Occupton. One, thank you everybody for being here. Thank you again, Rob. We have other webinars coming up. So in November, we have some financial webinars happening around balance sheets, cash flows, and understanding your growth and trends. So go to our website under events and sign up for those. And then December, we're closing it out and we're going to hear from an agriculture producer. And then Rob mentioned a lot of resources and tools. We also have some of those on our website too. You're welcome to visit our website, go under resources, and use any of those templates that we have available online. And the last thing that I want to add is our survey. I'm going to put it in the chat. We would love to hear from all of you about what other type of webinars you would like to see. A lot of these webinars were requested by producers, and so we want to bring you all of the information that would be useful for your operation. So, with that said, this recording will be on our website, and thank you so much for joining us today. Have a great day.